Hi, Assalamualaikum. We are Group 4. In this video, we'll be presenting about investment analysis for renewable energy projects, which is case 3. My name is Sadiah and this is my group members. Investing in renewable energy such as wind farm project and solar farm project actually has become increasingly attractive for investors for sustainable energy options. This investment offers huge financial returns in addition to significant environmental benefits. However, the financial feasibility and risk associated with these projects need thorough evaluation. We will present our findings in a clear and concise manner, ensuring that our client can make an informed decision that aligns with their long-term investment strategy.
Hi, my name is NURIN SOFEA, Nometric 284298. So I'll be presenting the objective of this financial model. So our primary objective in developing this financial model is to assist user in conducting a comprehensive analysis of various projects. And this model will enable user to evaluate and compare the potential investment opportunities meticulously, ensuring like a well-informed decision making. Specifically, we aim to assess each project truly to determine the most suitable investment option, be it a solar farm or the wind farm.
Hello everyone, my name is AIMI KHALIDAH and my matches number is 284430, and this is our input form for both project, which is wind farm project and also solar farm project. In this form, we fix the useful life and also useful life of 25 years for wind farm project and the useful life of 20 years for solar farm project. Other than that, we also fix the discounted rate, which is 8% for both. Also, on the tax rate, we make it a data validation to actually put in the figure itself. Other than that, on the bottom right, we have three buttons: NPV, Goal C, and Solver, and three both equally different output. And overall, this is the total output for the input form of the financial model, which indicates NPV, IRR, and also payback period. As you can see, in the wind farm project, for NPV and IRR is much more significant higher than the solar farm project. But for IRR, wind farm project will be 10% and solar farm project will be 9%. However, for payback period, it is the same. It is same for 9 years for wind farm project and also solar farm project. And also, with this output, it indicates that a high NPV means the project cash flow or discounted exceed the cash flow outflow by a significant margin. This indicates a strong profitability and that the project is expected to generate substantial value above its goals also. And a higher NPV suggested that the project is likely to perform well financially, and or if the and overall the higher combination of both is indicates that expected to be higher profitability but also resilient to risk also. And this dual indication makes the project more appealing to the investors seeking strong returns. And despite the inherent rate of return, such projects are often seen as valuable opportunities in the investment landscape, balancing potential reward with associated risk. And overall, the conclusion of this output itself, we can see that wind farm project is much more perform well than the solar farm project.
Next, we will look at the how changes in the discount rate affect the NPV of our wind farm and solar farm projects. And this slide shows the NPVs for both projects at different discount rate from 5% to 11%. For the wind farm project at 5% discount rate, the NPV is RM 8,283,196 ringgit and 42 cents. And at the discount rate increases to 6%, the NPV decreases to RM 1,118,104 ringgit 37 cents. And at 7%, it dropped further. And also at the 8%, it continues to decline, as well as the 9%, it reduces to 1,226,901 ringgit and 51 cents. And 8%, the NPV is from 4,729 ringgit and 89 cents. And finally, at 11%, the NPV becomes negative at 1,087,277 ringgit and 81 cents. For the solar farm project, just like the wind farm, the NPV decreases as the discount rate increases, showing that the high discount rates negatively impact the project financial viability. At 5% discount rate, the NPV is 3 million. The NPV is 3.6 million, and the increasing of the discount rate to 6% it results in NPV of 2.5 million. At 7% it drops to 1.6 million, and 8% it further decreases to 750,000. At the 10% it declines negative of 677,000, and finally at 11 discount rate it further decreases to 1.28 million. The sensitivity analysis clearly demonstrate that the both wind farm and solar farm projects are highly sensitive to the changes in the discount rates. As the discount rate increases, the NPV of both projects decrease significantly, with both projects turning into negative at the higher discount rates.
So next is for the sensitivity analysis. So we wanted to change annual revenue to achieve zero for NPV. So this is the outcome. For the wind farm project will be 2,647,402 and 41 cents. For solar farm project will be 1,890,745 and 84 cents. So if the wind farm project requires significantly more revenue to reach NPV compared to the solar farm, it is suggested that the higher associate cost, greater financial risk and potential lower cost efficiency. And also investor and project managers should be carefully weigh these factors against the potential benefits and return of each project to make the informed decision making in the future.
Wind farm project expected revenue is 5 million and the equipment cost would be 3 million, while solar farm project expected revenue is 6 million and the equipment cost would be 4 million.
Okay, next is solver. So the objective for our solver is to find the maximum value of net present value for both portfolio, which is wind farm and also solar farm. So for constraints, we have three constraints here. The first one is investment for wind and solar is more than or equal to zero. The second one is sum for wind and solar farm, which is less than or equal than 5 million. And the third one would be the risk for wind and solar farm, which is more than or equal to 6%. So the outcome from our solver is the NPV maximum for both wind and solar farm, which is 4,500,000 to 113 and 46 cents. So from there we get the NPV maximum for wind farm is 2915,002.32 cents. Then for NPV maximum for solar farm is 1587,111.14 cents. So from both of the NPV, we can see that wind farm has a higher NPV compared to the solar farm.
Hi, I'm NURUL SYAZWANI, number matric 284234. I'm gonna explain about limitation. So for our limitation, although our financial model is designed to provide comprehensive insight, it's important for the user to acknowledge our limitation that user may encounter. First, there are uncertain revenue stream. Renewable energy projects are subject to fluctuating energy prices, which can vary due to market dynamics and geopolitical factors. Additionally, regulatory changes can significantly impact the financial viability of this project. For example, changes in government incentive, subsidies, or tax policy can alter the projected revenue stream. Second, there is a limitation in the period of years set in the system. Our financial model operates within a predefined maximum time frame for the project. For example, we limit 20 years for the solar farm project. However, these renewable energy projects often have operational lifespan that extend beyond this period. As a result, our model may not fully capture the long-term financial outcomes and potential benefits of this project. Next, for the last one, which is the operational risk as significant factor, renewable energy projects involve complex infrastructure and equipment that are subject to potential failures and unexpected maintenance costs. Equipment malfunctions, wear and other operational disruptions can lead to unplanned expenses and revenue losses. These disruptions can affect the accuracy of financial prediction and must be factored into the risk assessment process.
Assalamualaikum and hi, my name is Alia Sadiah binti MOKHTAFIZAM and my metric number is 284375. Moving on is the recommendations for addressing a financial model limitations. The first one is a policy and regulatory monitoring. To mitigate the uncertainty of revenue streams due to fluctuating energy prices and regulatory changes, it is crucial to stay informed about regulatory changes and government incentives. So, by implementing a system for continuous monitoring of policy updates and market trends, will help in adjusting a financial models promptly to reflect the latest regulatory environment, ensuring more accurate revenue projections. Second one is the request and update, which is to mitigate the limitations in the period of years set in the system. For example, contact the provider or developer of the system and request an extension of the time frame. By extending the time frame, customer can better accommodate long-term projections and make more informed decisions based on a comprehensive analysis of the project's lifespan. Last one will be the robust risk management. By implement a comprehensive risk management framework can be used to address operational risks such as equipment failures or unexpected maintenance costs. This framework should identify, assess, and mitigate operational risks. Regular maintenance schedules, contingency planning, and investment in reliable equipment can help minimize disruptions, ensuring that revenue and expenses remain as predictable as possible.
Now I'm going to explain our overall decision based on our financial model. Overall, the wind farm project emerged as the most beneficial investment for our client. This conclusion is primarily supported by its high net present value, which exceeds 2 million ringgit in comparison with the solar farm project that achieved an MPV of less than $1 million. This shows that the superior MPV of the wind farm project indicates a more substantial return on investment, making it a financially attractive option. In addition to the MPV, the wind farm project also boasts a higher internal rate of return calculated at 10% compared to the solar farm project. The higher IRR further strengthens the case for the wind farm project as it implies a greater potential for profitability and a faster recovery of the initial investment. The benefits of the wind farm project is further demonstrated when considering changes in the discount rate. When the discount rate is adjusted from 8% to 5%, the wind farm project maintains a higher MPV compared to the solar farm project. This sensitivity analysis underscores the resilience of the wind farm project financial performance under varying economic conditions, reinforcing its position as a superior investment. However, it is important to acknowledge that the wind farm project entails a longer operational period compared to the solar farm project. This extended timeline introduces a higher degree of operational risk, which could impact the overall profitability of the project. Factors such as maintenance challenges, technological advancements, and regulatory changes could pose risk to the sustained performance of the wind farm. To mitigate these risks, it is crucial to implement a comprehensive risk management framework. This framework should encompass regular maintenance schedules, investment in advanced technology, and staying updated of regulatory developments to ensure compliance and adaptability. By proactively addressing these risks, the client can safeguard the project profitability and ensure its long-term success.
And the last one will be the conclusion. With this project, we have achieved the objective of giving advice to the investor on which project to invest on. And it is crucial to conduct a true work and relative sensitive analysis. So this analysis should delve deeply into various financial scenarios and parameters, offering a clear reflection on the financial model itself and the overall performance of the potential of the future project investment. With the incentives factor, the analysis will provide investors with a comprehensive understanding of the risk, return, viability of your project, and thereby facilitating well-informed and strategic investment decisions.